Good afternoon, everyone, and thanks for attending the webinar today. We've got about 150 people in the room at the moment, and we'll just get a few more in before we actually start the formal session itself. Well, good afternoon, everyone, and welcome to this ShineWing Employment Taxes Update for 2021. Welcome from wherever you may be joining us. I'm Helen Wicker. I'm a tax partner in our Sydney office, and it's great to have so many of you on the line. Firstly, I'd like to acknowledge the traditional custodians throughout Australia and their connection to land, sea and community, and we pay our respect to their elders, past, present and emerging. Our presenters today are from across the ShineWing National Practice. Tony Principe and Rahul Sangani will go through our FBT recap and hot topics. Justin Battachotto will present on global mobility and the impacts of COVID-19, including on residency matters, while Sam Morris will give us an insight into employee share schemes and payroll tax. Just a couple of housekeeping matters before we start. We recommend that you click on the Enter Full Screen button at the top right-hand corner of your screen to achieve the best webinar experience. And if you click on the Q&A button at the bottom of your screen, a window will pop up to allow you to send us questions as we go. We'll try and answer them either throughout or at the end of the session if time allows. Otherwise, we may need to be in contact with you at the end to answer those questions. We will be circulating the slides at the end of the webinar, so don't feel concerned that you need to be jotting everything down. And during the webinar, we will run 2 live polls. The first poll will appear on your screen now, and it can be accessed at any time using the poll button at the bottom of the screen. The second poll will be launched during the webinar itself. Now I'm going to hand over to Rahul to cover our employment taxes matters.
Thank you, Helen, and good afternoon, everyone. We'll first go through some key dates for FPT. So the FPT return is ordinarily due on 21st of May, but if you are using a tax agent, you get a 7-day extension for payment, and the lodgment due dates get extended until 25th of June. Every year, the Commissioner issues rates and thresholds that apply for the relevant FPT year. For example, the cents per kilometer rate, which was generously increased by 1 cent. I'll not go through each of them, but we've got reference to those in this slide in case you need them. And lastly, the FPT rates and the gross up factors remain unchanged. This year has been a bit different from other years where we've adapted to the new remote working style, and travel was the last thing on anybody's list, but the ATO. In February, ATO issued 3 guidances on travel expenses. The first is a ruling on transport expenses, TR 2021-1. This ruling reasserts the general principles around deductibility of travel costs between home and work, and highlights that for a transport cost to be deductible, the need to travel should be a requirement of the employment instead of merely being a result of employees' preference. In particular, ATO has provided some rich commentary on what is considered an alternate place of work in this ruling. One of the key tests in that ruling keeps referring to the test in the full federal court decision in John Holland case, which is whether the employee is under the direction and control of the employer while traveling. Next is a draft tax ruling, TR 2021-D1 on accommodation, food, and drink expenses. This draft ruling provides ATO's views on the concept of living expenses, which are personal in nature versus travel costs, which are work-related. It also sets out the factors to consider when determining whether an employee is living at a location or relocating. To complement this draft ruling, a practical compliance guide was also issued, which outlines ATO's approach in deciding whether an employee is traveling or previously disregarded has now been reintroduced in this practical compliance guide with some conditions. The key one being that travel to any one location should exceed 89 days total during the FBT year. This should provide some certainty to employers when drafting travel policies. With the release of these three guidances, the old tax ruling, TR 2017-D7 withdrawn. The old ruling provided guidance on all travel costs, but now we have separate guidances for transport costs and coexisting workload on the general principles of deductibility in these new guidelines. These rulings are quite timely given the remote working patterns developed in the last 12 months and anticipated demand for travel once everyone is vaccinated. In the next set of slides, Tony Principi will discuss some common fringe benefits.
Tony, I think you're still on mute.
I think, Tony, you're on mute.
Thank you, Rahul, and good afternoon to all who have joined our update. As noted earlier, the next session will cover the fringe benefits that are most commonly provided, as well as consideration of the impact of COVID referable items to such benefits. Firstly, we'll start off with motor vehicles or cars as the most commonly provided fringe benefit. Nothing has changed of any substance in regards to this type of fringe benefit. But the one thing to note that is quite often overlooked is that even in respect of motor vehicles that are provided to staff that don't necessarily qualify as cars, that a fringe benefit can arise. So as per the slide, there's the example of all dual cabs that have a carrying capacity of greater than 1 tonne, don't qualify as cars. However, if they're provided to staff for private purposes and they don't fall within one of the other exemptions, there's still the possibility of residual benefit arising in those circumstances. If there is a residual benefit, it's ordinarily determined by determining the number of kilometres travelled for private purposes times an appropriate rate to come up with the FBT taxable value. In respect of cars specifically, it's still a case that there are two methodologies to be able to determine the taxable value associated with the motor vehicles. Statutory formula, which is predominantly set on a concept of availability of the vehicle for private use, as compared to the operating cost method, which is primarily connected to the concept of a fringe benefit being provided. The difference in the concepts is quite important when we consider the impact that COVID may have in this respect. As has been the case across the whole of the country, due to COVID-19, it's probably a case that employers have been garaging their work cars at their employees' homes. The ATO have noted in such instances that they may in fact not be in the FBT liability depending on the type of vehicle, how often the car is driven, and the calculation methodology chosen for the car benefits. As always, generally car fringe benefits will arise where an employer provides a car for the private use of an employee. Therefore, if the employee is garaging a work car at home, prima facie, the employer is providing them with a car fringe benefit. The ATO in recent months have released a fact sheet for employers who find themselves in such a situation. In essence, the ATO have noted that where a car is not being driven at all, or only being driven for maintenance purposes, the ATO deem that the car is not being held for the provision of a fringe benefit. So the important part of that is that it's a deeming of not being held for the provision of a fringe benefit. So it aligns with the concept associated with using the operating cost method. Where employers do choose to use the operating cost method, the taxable value of the car could in the extreme be nil, and so there will be no FBT liability. Employers will need to maintain odometer records to show that the car has not been used during the period. Correspondingly, in order to use the operating cost method, there is a requirement to have a 12-week logbook that's valid for the current year. Obviously, in circumstances where the employer is not able to satisfy those requirements, the default will end up being the statutory formula method. And unfortunately, in these particular circumstances, there's no particular concessions that apply in respect of the vehicle being garaged at the employee's home. The important thing to note as well is in respect of logbooks, the ATO has stated that where employers use the operating cost method, they may already have an existing logbook. If this is the case, they may choose to continue using that logbook to make a reasonable estimate of the business kilometres travelled during the year. Or employers can also elect to keep a new logbook, which is representative of the business kilometres travelled during the year. Now, the advantage at the end of the day of using the operating cost method is that because the period where the vehicle is not being used and garaged at the employee's home is regarded as not being the provision of a fringe benefit, any costs incurred in respect of the car that are referable to that period get excluded from the calculation of the fringe benefits taxable value. As a result, if the car wasn't being used for 6 months due to COVID limitations in terms of people having to isolate, etc., then in that particular circumstance, there's potentially 6 months of costs associated with the car that don't get included in the calculation of the fringe benefits tax liability. So that would include, as an example, depreciation on the car, the interest component referable to the car, the annual registration costs, insurance, etc. So there is capacity where one is using the operating cost method to significantly decrease the FBT liability that would otherwise apply. So all things being equal, if the proportion of kilometres travelled for business is similar to what it has been in earlier years, you may in fact find that your FBT liability is reduced from earlier years due to the fact of the exclusion of the costs for the period where the car is effectively static. For those employers who haven't maintained logbooks in respect of some of the vehicles, there's still the opportunity to obviously bring yourself within the rules, provided the logbook referable to the motor vehicles is started before the 31st of March this year, notwithstanding that the 12-week period may extend into the next FBT year. That logbook can be used for the purposes of substantiating your position in respect of the operating cost method. Another thing just to remember is that the ATO did issue in 2018 PCG referable to effectively tool of trade type vehicles. In that instance, the ATO has noted that tool of trade vehicles, which are vehicles other than cars, are not subject to FBT, provided the private use is minor and infrequent. With a tool of trade vehicle, home to work travel is not considered to be private. You're able to self-assess the position as to whether or not there is infrequent private use of the vehicle. However, it is important to note that apart from self-assessing, there is also a requirement to qualify for the exemption that the employer has a policy in place that limits the private use of the vehicle and also seeks to obtain assurance that the use is limited. This is something that is at times overlooked and therefore disqualifies the entity from being able to claim the exemption. Perhaps next, if we go on to car parking, probably an expense that's been somewhat limited given the quarantining and other requirements that have existed across the whole of Australia. The rules in respect of car parking benefits in themselves haven't altered. So in essence, if an employee is able to drive their car into work and park at a parking station that's either owned or leased by their employer, and is able to leave the car there for at least 4 hours between the hours of 7 a.m. and 7 p.m. And the commercial parking stations in the area within a 1 kilometre radius charge at least $9.15 for the 2021 FBT year in respect of each day of parking. A car fringe benefit will arise, or prima facie arise. The methodology of determining the value of the car parking space have remained the same. You still have 3 choices all the way through from getting an authorised or qualified valuer to come up with a market value through to using comparables with commercial parking stations in the vicinity of the parking lot that's being used. Once the value is determined, you then have a choice of 3 methods of calculating the annual taxable value. They can vary from the quite detailed approach of determining the use of the car park on every single day, alternatively falling back to maintaining a 12-week register and then extrapolating that for the whole of the year, or alternatively using the statutory formula method, which assumes that there are business days available for the car park of at least 228 days. The things that are probably relatively new in respect of car parking are twofold. One has been the recent announcement that for small business employers that meet particular criteria, the thresholds referable to those criteria have changed. So small business employers can actually obtain an exemption from treating car parking benefits as subject to FBT in certain circumstances. From the 1st of April 2021, one of the thresholds to qualify for that exemption has been increased from a turnover of less than 10 million to a turnover of less than 50 million. The other matter of note, which has yet to be finalised and which we understand the ATO intends to finalise by the 1st of April this year, is the ATO's view as to what constitutes a car parking facility. The ATO now considers, per the draft ruling, that a facility can qualify as a commercial parking station, even if it has a purpose other than providing all-day parking. The classic examples in these ones are the alley parking that may be provided at hospitals or airports or shopping centres. And in this case, even if it's a fee structure that discourages all-day parking, the view per the ruling is that it still qualifies as a car parking facility. As a result, for those employers who potentially weren't anywhere near a car parking facility previously that qualified, for comparison purposes, they may find that in fact the car parking that they're providing to their employees from now on actually is subject to FBT because of the fact that they have a shopping centre in the vicinity that's now regarded as being a commercial parking station. In terms of COVID impacts associated with car parking, there are a number of matters to take into consideration. In respect of closure of work car parks, if on a particular day your office is closed due to COVID-19 and therefore the work car park is also closed, you'll not have provided a car parking benefit as there's no car park space available during the relevant hours. The time during which the work car park is closed will not form part of the availability periods used to calculate the taxable value of the car space under the statutory method. So in other words, what will then happen is be a ratcheting down of the potential annual FBT liability because of the fact that you are excluding from the calculation a period of time where effectively there is no benefit. Correspondingly, if there's been closures of nearby commercial parking stations that are within a 1 kilometre radius of your business premises and they're all closed during a particular day due to COVID-19, there will be no car parking benefits provided in those circumstances. And finally, one thing that has probably arisen more so from a commercial perspective is that in order for the car parks to be viable, a number of them have chosen to reduce their rates at various times during the FBT year. If they had done so on the 1st of April 2020 and the lowest fee charged by all of the commercial parking stations within a 1 kilometre radius of your business premises for all day parking was less than $9.15, you will not have provided a car parking benefit to your employee on that day. This may occur where all the car parking stations have dropped their rates significantly. However, it is important to note that the reduced fee must not be substantially greater or less than the average of the lowest fee charged by a commercial parking station operator in the 4 weeks prior to 1 April 2020 or the 4 weeks after 1 April 2020. In those circumstances, if the average rates are in fact higher than the rate at 1 April 2020, then the reduced fee on 1 April 2020 will be disregarded and a FBT liability may in fact arise. Next, I'd like to go on to the topic of entertainment. No changes here, but it is important to ensure that we do appreciate as to what it is that falls within the regime of what constitutes entertainment as compared to expenditure for things like sustenance, meals while travelling or eligible seminars. The crux of it in terms of the COVID impact is that whereas once upon a time, many employers would have chosen for a matter of convenience or expediency to choose to use the 50-50 methodology of determining what extent of entertainment expenditure was subject to FBT. With the reduced quantum as well as number of entertainment expenditures arising during or potentially arising during the current FBT year, it would be worthwhile doing an actual comparison to determine whether or not the actual methodology is going to produce a better result, especially given that in a number of instances where you are using actual methodology, even where a benefit does arise, it's highly likely that the benefit will also qualify for an exemption as a minor benefit if it's less than $300 and is both irregular and infrequent. Some of the other benefits that are probably worthwhile considering further in the climate of the COVID pandemic include the living away from home allowance. So in ordinary circumstances, there are concessions under the FBT legislation as to the treatment of living away from home allowances that qualify as such under the FBT legislation. There are various criteria that need to be satisfied in order for the concessions to apply. And it's the nature of these criteria that potentially have an impact in a COVID environment. So if we take the circumstance of an employee who might be returning early from their assignment, given the shutdown of operations or other matters that have forced that to occur as a result of COVID, the thing to be mindful of is if the employee has in fact returned early, but they continue to receive a living away from home allowance, then consideration needs to be given to whether in fact such an allowance is something other than a living away from home allowance and potentially an allowance that's subject to PAYG. You may also have circumstances where the employees may be temporarily stuck and therefore they've exceeded their concessionary period of 12 months at the location that they're living away from home at. In those particular circumstances, at this point in time, there's no concessionary treatment for any payments that are made for the period beyond the 12 months period. And finally, for those employees that are fly in, fly out or drive in, drive out to sites who can't actually travel home consideration should also be given to whether or not there are any exemptions that might be applicable in respect of the benefits that they're being provided with. Finally, in terms of other benefits that have probably become or will become commonplace, there is consideration as to what exemptions may apply. If we look at COVID-19 screening as an example, you won't have to pay FBT for providing COVID-19 testing to employees if both the testing is carried out by qualified medical practitioners or nurses and the testing is available to all employees. So even in circumstances where you may have employees who refuse to undertake the testing, provided the testing is available to all employees, it will in fact be exempt from FBT. Then in terms of considering emergency accommodation where people have been stuck or have had to be repatriated for one reason or another as a result of the pandemic, the FBT emergency assistance exemption may apply if you provide emergency accommodation, food, transport, or other assistance to an affected employee. Benefits that also are provided to allow an employee to self-isolate or quarantine can also potentially fall within the exemption associated with emergency assistance. Finally, one thing that's obviously become quite commonplace is having the majority, if not all, of staff working for some period of time from home. And as a result, being provided with equipment or consumables in order for them to undertake their tasks. In most instances, items will usually be exempt from FBT if they're primarily used by employees for work purposes. These items include things like laptops, portable printers, other electronic devices. Also, consideration should be given as to whether or not the minor benefits exemption may apply to other items where you may be paying for somebody's internet bill that may include a private component as an example. And finally, as is always the case with any of the fringe benefits, consideration also should be given to whether or not the otherwise deductible rule would apply, in the sense that if the employee had incurred the expenditure themselves rather than it being subsidised or the expense being reimbursed by the employer, whether they would have been entitled to a deduction. And finally, just in terms of administration, nothing has changed in this regard from what you would have done previously, but one of the important points to note is that with people potentially working remotely or working from home, the ability to potentially get access to signed and hard copy declarations may not be all that easy. But the FBT legislation does provide for electronic declarations to be acceptable where they're available. And it should be noted that whether they're electronic or hard copy, they all must be to hand before the FBT return is lodged for the declaration to have the appropriate impact. Finally, I'll note that as part of our CTS software package, we now have an extremely easy to use FBT component, which will assist to simplify the compilation of information referable to the FBT return and the preparation and lodgement of such a return. Now, I understand we'll have another polling question that will come through now, and at the same time, I'll hand over to my colleague, Justin.
Thanks, Tony, and good afternoon, everyone. My name's Justin Battichotto, and I'm an Associate Director in the Tax Division in our Melbourne office. This afternoon, I'm going to talk through tax residency and the challenges and changes that have occurred due to the global pandemic. Firstly, why is tax residency important? And there's probably two key concepts that we're going to touch on today, one being tax residency and the other being source of income. Now, tax residency is very important for both an individual in determining what income is accessible to them in their individual tax return, but also for an employer to understand whether they have employer obligations such as pay-as-you-go withholding, reporting, super and FBT. So generally, an individual who's deemed to be a tax resident of Australia is assessed in their individual tax return on income from worldwide sources, whilst an individual who is deemed to be a non-resident of Australia for tax purposes is assessed in their individual tax return on Australian sourced income only. And you can see this table illustrates some of the key differences around how their income is assessed in their tax return, being different tax rates, certain eligibility to tax offsets or liability for levies and surcharges. And there's some key capital gains tax differences depending on whether an individual is a resident or a non-resident of Australia for tax purposes. So that consideration is quite an important assessment to make. So COVID has really created some challenges around individuals not necessarily residing in the country that they typically perform their services and live and reside. We've probably all seen in the media and on the news highlighting, tens of thousands of Australian citizens that have temporarily returned to Australia to see out the global pandemic. And this has created some real issues around how has this impacted their individual tax residency status. In March and April of 2020, the Australian government and the ATO came out and provided some guidelines for individuals that found themselves temporarily back in Australia for some weeks or months. And the ATO's guidelines or guidance was that an individual wouldn't necessarily become a tax resident of Australia if they usually lived overseas permanently and they intended to return there as soon as they were able to. The ATO did, though, highlight that if that individual ended up staying in Australia for a lengthy period of time, and the ATO did not define what a lengthy period of time is, or their intention changed so that they perhaps were not intending to return to their usual place of residence, then that individual should consider their tax residency status in Australia. At the same time, the ATO also provided guidance for individuals that were ordinarily living and residing in Australia that found themselves temporarily stuck out of Australia, that those individuals would still be treated as a tax resident of Australia unless their intention changed around their return to Australia. So this tax residency issue has created additional complexities for both individuals in understanding what they need to include in their individual return, but also a flow and impact for employers around, well, does this create any additional or new employer obligations for those employees? So as we touched on one of those earlier slides, tax residency is a real key consideration, and depending on their residency and the source of their income will determine what gets included in their return. So the second concept we really need to unwind or unpick is how do we determine source of income? And it is really dependent on the facts of the case. But generally in relation to salary and wages, the location where the employment is exercised or where the individual is physically performing those services is a significant factor in determining source of income. So with a lot of individuals now that would ordinarily be living and working overseas that might find themselves temporarily in Australia, and we are seeing that many have agreed remote working arrangements with their overseas employers, this is creating a really special set of circumstances around, is that salary and wages now accessible in Australia? And does that salary and wages have an Australian source? So again, the Australian Taxation Office were on the front foot in March and April of last year, and they did provide some initial guidelines that said, if an individual is under a remote working arrangement in Australia, and they are working in Australia for a period of 3 months or less, the income or their salary and wages they derive would not be deemed to have an Australian source. However, if that remote working arrangement went beyond 3 months, then further consideration would need to be undertaken, as that would firstly have an impact for the individual in what they need to report in their individual return, but also for their employer around whether that employer now has reporting obligations, withholding obligations, super, FBT, etc. So for anyone that found themselves working remotely in Australia beyond 3 months, The ATO's further guidance was then you would need to consider whether, firstly, Australia had a double tax agreement with the country that they were ordinarily residing in, and whether the short-term visitor exemption would apply. So the way that the double tax agreement works with the short-term visitor exception is that certain conditions need to be satisfied in order for that employment income not to be assessable in Australia. So we've outlined there in the slides what those conditions are. So firstly, the employee needs to be a resident of a country with which Australia has a double tax agreement. The employee cannot be present in Australia for more than 183 days in aggregate in either an income year or a 12-month period, and that will be dependent on the double tax agreement that that the individual is considering. The employee will also, the salary and wages that they receive can also not be from an employer who is a resident of Australia. And the employee's salary and wages are not deductible against profits of an Australian permanent establishment of the employer. So where those conditions are satisfied, then the individual's salary and wages will be exempt from tax in Australia. However, where an individual does not satisfy those conditions, then the salary and wages that they are deriving whilst working remotely here in Australia would be taxable in Australia. This will also then create employer obligations for their employer, including pay-as-you-go reporting and withholding, superannuation guarantee, FBT, etc. So that was really looking at what happens for a lot of those individuals that are finding themselves temporarily in Australia. We're also seeing a lot of situations where Australian employers have remote workers working outside of Australia. And the common scenarios that we're seeing is where employees that were ordinarily working in Australia are now finding themselves temporarily stuck overseas, and they have an agreement with their employer to continue working remotely. Or what's becoming more and more common is where Australian employers are looking to recruit new talent, and that talent sometimes sits offshore, but they are unable to relocate those individuals to start their role due to international border restrictions. However, they don't necessarily want to wait for that individual to physically relocate, so they're commencing their employment remotely. So this creates a number of issues, firstly for the individual that we've touched on, but around the individual's residency status, how the double tax agreement will impact this arrangement, as well as what level of support is the Australian employer going to provide this individual to navigate through the multiple jurisdiction tax issues that they're going to have to work through around where that salary and wages becomes assessable. One of the key considerations for these arrangements where an Australian employer has a remote worker working in another jurisdiction is, does this create a tax obligation for the Australian employer? So if you've allowed an employee to work remotely in the US, for example, does this mean that you now have to register as an employer in the US? Do you need to be reporting and withholding, contributing to Social Security, etc. in the US? It also creates a potential permanent establishment risk that needs to be considered. The other key considerations are really around insurance. Is that individual covered under work cover, or do you need to take out additional appropriate insurance in the US? As well as, do your internal policies and procedures cover a remote working arrangement, in particular, not necessarily just working from home, but working from another jurisdiction? So this is what we're understanding and seeing a lot more organisations having to deal with. And I just wanted to finish off on one particular case study just to illustrate some of the challenges that organisations are facing. So we were helping an Australian employer that did have a number of employees working remotely in the US. They had been quite proactive and had engaged with a global payroll provider to assist with their international payroll in the US. What they soon uncovered was that the scope of what a global payroll provider, what services they can provide is really narrow in definition and really focuses just on the payroll delivery. But those initial registrations at both federal and state level in the US as well as liaising with tax authorities, was something that the global payroll provider were unable to provide. So in this situation, we were able to utilize our global network to assist with those federal and state registrations, as well as liaising with the local tax authorities in that jurisdiction. So there are a number of key challenges where you do come to an agreement with an employee around a remote working arrangement, but it's important that you're managing the employee's expectations, you have the appropriate buy-in from key stakeholders, and understand and get the right advice around what are the requirements in that particular location, because every location does have their own set of rules and facts that need to be worked through. So I'm now going to pass it across to Sam Morris, who will take us through the rising popularity of employee share and incentive plans.
Thanks, Justin. I'm Sam Morris. I'm a tax partner in our Melbourne office, and I lead our employment taxes team. So in terms of employee share schemes, we have in previous sessions talked about these before, but I think it's important that, and worthy of a recap, as we're seeing much more activity in this area. And there's definitely been a resurgence in the popularity in the past year or two, with some really great benefits for attracting and retaining key staff. So incentive plans are typically where employees are offered shares or rights to future shares in the business of their employer. There's special tax rules that are in place to provide concessions and tax breaks for eligible plans. And typically any discount that's provided to the market value is taxed up front to the employees, unless the plan qualifies for tax deferral. In some instances, it can be attractive to have tax up front if the value is negligible, but commonly employees are looking for tax deferral opportunities. So there's several different types of plans that would typically be considered. We'd always recommend that you explore these in the context of really the strategy behind what you're trying to achieve. We're not going to go into these in any detail today, just for people to be aware that it's not a one-size-fits-all type arrangement. So the key reasons that organisations would typically consider such incentive plans are really around engagement and retention of key staff, looking to reward past performance, but I think really critically seeking to reward future efforts and incentivising staff to have, I guess, some skin in the game and work towards a common goal. So we're seeing a number of businesses consider incentive plans much more as they seek to, I guess, grow in the post-COVID world, if we can say post-COVID. So certainly in the last year or so, as organisations have redeveloped and evolved their businesses and looking to grow further. So probably the most common concessions and certainly one of the most attractive are the ESS startup concessions. These were introduced back in 2015, but I think it's really only in the recent couple of years that they've started to, I guess, stretch their legs. Eligibility criteria is everything. We've noted some of the key points on this slide. Probably two primary things to think about. One is that if you've got a business that's looking to exit within 3 years, that there is a 3-year minimum holding period, although that can be reduced by commissioner if for example there's 100% takeover of the shares. So it's really that you need to have an intention and your documentation to support a 3-year minimum holding period. And importantly, the discount cannot be more than 15% of the market value at the date of the grant. So this means that you can't simply provide free shares to employees But we do find that under certain circumstances, the market value can be very low at the time of grant. So it could be a negligible amount anyway, even with a maximum of 15% discount on market value. So in terms of some of the key benefits, again, we're talking about eligible startup plans here. For employees, if they receive shares, there is no tax to the employee until they dispose of the shares. If they've received options, there's no tax at the grant or at the exercise of those options. We're then into CGT on the ultimate sale of those shares that resulted from the exercise. And because we're into CGT territory, subject to the 12-month holding period, the employee would then get the benefit of the 50% CGT discount. So that can be quite an attractive option compared to paying income tax. I guess in an attempt to make things easier, I always hesitate with that with where tax is concerned. For small businesses, there is an ATO approved valuation methodology, and this can result in quite low valuations for employee share scheme purposes, as it's based on a net tangible asset basis rather than a full market value of the entire company. So that can be useful to be across. And importantly, during, I guess, periods of initial growth, the startup concessions can be really helpful to assist with cash flow hurdles. So particularly where you're trying to reinvest as much as you can back into the company in early stages, a share plan or an option plan can really help with some key employees to supplement traditional remuneration rather than just paying everything out in cash at the time. Obviously important to get advice and choose the right type of plan for your business and your strategic goals. Also important to ensure that the documentation is drafted appropriately. I think it can be easy to just cut and paste at times. So I think we always need to make sure that that each organisation has accurate rules and plan rules, option letters, various documentation that go to the employees to make sure that it's appropriately within the eligibility rules for the type of plan that you're looking to implement. And also so that there's no unintended consequences for the company itself or for the employees and the tax outcomes that you're looking to achieve. Companies need to remember that there are reporting requirements, as there are with most areas of tax these days. We still see many examples of reporting not being done sometimes at all or accurately. This might include not including the discount amounts for payroll tax purposes. That's a very common misconception to not include anything to do with share scheme reports for payroll tax. And also there is annual reporting that is required to disclose discounts to the tax office. This can be a common difficulty for companies that are subsidiaries of overseas organisations. So where reporting is required in Australia, but maybe the plan is managed overseas and might not in fact be really geared up for Australian tax implications. So just something to be aware of. We provide a lot of assistance to our clients through our, our CTS suite of technology solutions. We have a share scheme reporting tool, which can help both with calculations and with lodgement of reporting. Might just move on briefly to payroll tax. We've got a number of slides here. These are probably as much of a reference after the webinar as going through here. So just in the interest of time, I might just fly through some of these, but you'll all have them in your packs afterwards. COVID-19 concessions we've been talking about a lot today. We have a full suite for the states and territories in relation to the concessions that were brought in an attempt to combat COVID-19 difficulties. Most of these relate to the 2020 income year, but there are several opportunities for employers to be aware of for 2021. We've got a slide here just around Jobkeeper. So obviously a lot of businesses did utilise the benefits that Jobkeeper provided through some difficult times, due to end obviously this month. But in terms of most of the states and territories have exempted all Jobkeeper payments from being included as taxable wages for payroll tax purposes. So that should be fairly straightforward. There are some slightly different rules in terms of New South Wales and Victoria in relation to employees that have been stood down, or where part-time or casual employees have been paid amounts that are exempt from payroll tax. Here's just a bit of a snapshot of the different states and territories and the waivers that have been applied. So that's obviously in your pack, so I won't go through that in detail. And also some deferrals that have been afforded in the different states and territories as well, which, as is quite typical with our states-based system, lots of differences and slight difference in dates as well in which those deferrals apply. And then just a couple of noteworthy concessions going forward. So we have for New South Wales, a fairly recent announcement around the Job Plus programme. This provides some payroll tax relief for up to 4 years for businesses. There is some eligibility to watch out for, and we're really looking at creating 30 plus new jobs, but that does have some slight tweaks depending on whether you're an Australian business or you're an overseas business with employees here. So just to watch for there. A temporary reduction in payroll tax for 2021 and 2022. Tasmania has announced a young employment payroll tax rebate, which is currently in place. And for Victoria, the concessions are more around a credit that's provided, whereby Victorian taxable wages paid for this the current year is above the previous year, a credit will be applied to those. We have a lot of information around the concessions and things on our Think Big channel, which is on the screen there, which is part of our website. Lots of other COVID information, which I'm sure has been very relevant for a lot of businesses in the last year. That's all I had on payroll tax. I'll hand back to Helen to close out the session.
Thanks, Sam. That's great. Well, there was a lot of material to be covered through the session today. Sorry about the technical difficulties at the beginning. We were going to potentially recap that, but I think time won't allow at this point. I guess a couple of things that occur to me as we go through, reflect on the topics we've covered. In terms of car fringe benefits, so COVID-19 is going to have a big impact on fringe benefits and income tax over the current period. It isn't too late to start a logbook for the 2021 year if you decide that it's appropriate to at least have the option of using the operating cost method for valuing your car fringe benefits. So a logbook that commences before the 31st or by the 31st of March and is a valid logbook would be appropriate would potentially be able to apply to both the 2021 and the 2022 years of income. So because there are a couple of specific implications, particularly for anyone who was not using their vehicle during a lockdown period, it may be beneficial to make sure that you've got the logbook option available to you. Payroll tax, I think Sam going through all of the detailed payroll tax rules for particularly the concessions in the various jurisdictions. Be important to look at all of the jurisdictions in which you've got employees and see if there's any concessions available there. And I'd say as well, just be very wary of the COVID-19 impacts on employees. You know, whether employees are perhaps trapped in another location, and there are possible local tax implications to think about, and then also for people who are coming into Australia and working up their international tax exposures can be quite critical. Just looking at, we ran a couple of polls during the session, and interestingly, the second question in relation to the car park definition. So there was only about 14% of people thought that they would be likely to be impacted by that change in the definition of car parks, with only 30% thinking that they would potentially be impacted. I would encourage you to just have a really close look at whether a car park in your area is perhaps now defined as a commercial car park under the new interpretation. I know for me personally, I've got a shopping centre within a kilometre walk of my home, not my business premises, but of my home, that previously wasn't classed as a commercial car park and is now. So I think it's just something to be very mindful that it is possible that you could be caught by that expanded definition without realising it. The other question was in relation to whether people felt that car and FBT, their car parking and fringe benefits tax implications for 2021 would be higher or lower than 2020. And it's probably no surprise that about 57% of attendees thought that their 2021 FBT exposure on cars and car parking would be either nil in some cases or lower than in 2020. I think we'll see big impacts on government collections around FBT with some of the changes, and I think making sure that we've got all of the documentation to support the lower rates of FBT that should be applying will be quite important for everyone. So that brings us to a close. We've had a number of questions that have been answered through the chat. If there are any unanswered questions, we'll be in touch with a response. And if you do have any further questions that we haven't addressed during the webinar, please make sure to speak to your usual ShineWing advisor or send through your inquiries by email to one of the speakers on the screen, and we will send you the slides after the session. We'd also really value your feedback on the webinar, so please complete our feedback survey, which will pop up on your screens at the end. We look forward to providing you with further updates in due course. Thanks for joining us. Be well, stay healthy, and we'll see you soon.